Good afternoon, everyone, and welcome to Stock Market Today. It's Coram and Ken Shreve here with a breakdown of the action in today's session, where we saw another not so great day, and the Nasdaq is testing support at a key level with tech stocks taking the worst hits today, Ken.
Yeah, Nasdaq closed just above its 50-day moving average. S&P 500 extends its losing streak to 5 sessions. The good news is we had lower volume, so we avoided the S&P's third straight distribution day. We'll take a look at 3 stocks. Not many tech stocks holding up that well, but Parsons, a rare bright spot in the enterprise software group. PSN is the symbol there, and also 2 non-tech stocks, Train Technologies, ticker TT, and also Terex, ticker TEX.
All right, well, giddy up on those. We'll take a look at that. But first, let's take a look at the major indexes today. So the Nasdaq down 0.5% by sessions close, followed by the Russell 2000 down 0.3% today. The S&P off 0.2%, and the Dow closing flat, just fractionally in positive territory today. So we have, in a couple of days, erased all of the last Wednesday Fed Powell boost gains and then some now, Ken. And as you say, the Nasdaq is now testing a pretty critical level on the chart.
Yeah, selling pressure definitely building here, and we had I guess a market tide that had been flowing positive for a little while, but yeah, watching to see if the Nasdaq can hold support here. Again, volume was lower today, so that was sort of a silver lining to an otherwise fairly dull session that saw tech stocks lag again. Selling pressure pretty muted in the S&P 500, but still lost ground for the 5th straight session.
Exactly, with another close below that 21-day line after breaching that level in Tuesday's session. So Ken, does it seem like we're now at a level where we could see a bit of a bounce, or does it feel like we are seeing more negative action to come with this resistance at that key 200-day line that we saw for the S&P, similar to how it acted in mid-August?
Yeah, I think between now and the end of the year, I think we're just going to see a back and forth market. The market's going to make us feel good with a really strong up day, and we could get that pretty soon with the S&P 500 down again for 5 straight sessions. Maybe not entirely oversold here, but still after 5 straight declines, could see a bounce. But and then we'll see how it does around that 4,000 level. But yeah, the real issue for stocks right now is what's going on in this bond market. We had a big drop in that 10-year yield on Tuesday, and it was down another 10 basis points today. So money is just piling into bonds here, and yeah, this 10-year note really at a key level here. You can see. So we'll see if the bleeding eventually stops. I think the market probably wouldn't mind seeing this 10-year yield start to right itself and rise a little bit, because with the way the 2-year and the 10-year yield are inverted, the bond market is telling a pretty bearish story about what the economy could look like next year.
Absolutely. Really interesting to see. And as we've been commenting as of late, there was a pretty strong inverse correlation between what we were seeing with the 10-year yields and the stock market, but now it does not seem like that correlation or divergence is as strong.
No, it has completely changed. We saw this huge move in the 10-year Treasury yield, and this was when the Fed was in the middle of these 75 basis point hikes, and they've hiked rates four times in a row, 75 basis points. So we'll probably get 50 basis points next week. But when those bond yields were surging, it was almost like the bond market was just catching up to the Fed and raising interest rates to fight off inflation. And now with the Fed's terminal rate probably landing in this area of around 5%. Fed rate, there's probably only going to be 2 more rate hikes before they pause. That's still debatable, but that's a likely scenario. So it's not like the Fed right now is in the early stages of embarking on these rate increases. We'll get 50 basis points in December, and then the market is still kind of grappling at the February meeting if it's going to be 50 basis points or 25 basis points. But after that, we're probably going to stand tight, and we'll see how it goes. But the rate increases are, you can kind of see the light at the end of the tunnel. But it really is dependent on economic data. We've got inflation data Friday. We've got more inflation data next week, the Fed meeting. So there's a lot of headlines that we could see between now and February.
Yes, a lot of headlines and a lot of market movement in reaction to those headlines that we're going to have to navigate. Let's also take a quick look just across the board at how some of the other indexes acted today. So here's a look at the Dow. It's continuing to pull in, testing that 21-day line with basically a flat close today. But Ken, since we've had such a strong move off the lows for the Dow, I mean, this action kind of makes sense at this point to see it pause and take a breather. Now, I guess the question will be, is this the place where it's going to bounce, or what will we see from here? Will we see Dow stocks and other industrial-like stocks, pausing to form add-on entries in an area that has now seemingly taken the leadership baton for now?
Yeah, it just seems like industrials and Dow type companies, even big cap 20 type companies. We have the big cap 20 index that we track at IBD. So it seems like this is the stocks that the market is favoring here, and that's reflective in just looking at the daily price and volume in the Dow. Just a test of the 21-day moving average here, but it's been a really strong move off lows. So it'll probably just consolidate a little bit up here, and we'll see. But it's been the strongest performing index. Meanwhile, you got the S&P 500 and the Nasdaq, clearly the weakest index at this point, and small caps starting to look a little vulnerable here as well.
Exactly. Yeah. Here's a look at IWM, which tracks the Russell 2000 and NBY. The mid cap index coming off NBY still trying to hold above its 200-day line. We'll also take a look at XLE continuing to see further erosion here this week. It's below the 50-day line and the 10-week line on the weekly chart here by a little over 3%. We still have 2 trading days to go. We'll have to see if it can get support at that moving average, or if it does close over 2% below that level, maybe that's a signal that these stocks need a little bit more of a breather.
Well, we've seen that this isn't reflected in the XLE chart, but there's been some pretty stiff selling among a lot of these energy stocks that had been working in the large cap, small cap, mid cap space. It's been pretty broad based. A name like Matador Resources, MTDR, for example, you can see this was a pretty sharp break of its 10-week moving average. And then some of your really mega cap oil and gas producers, a name like EOG. Definitely an institutional quality name. Here's a break, and Pioneer Natural Resources, PXD. So we're really seeing selling start to pick up in the oil and gas sector, and it makes sense. I mean, oil prices have just been kind of following bond yields lower here in anticipation of weak demand and softness in the economy. And as we've been saying in recent videos, this is just a market kind of grappling with how much is the slowdown going to be next year? Is this really going to be long and drawn out, or is it going to be, sort of a shallow recession? So that remains to be seen. But like I said, the bond market and oil prices at this point kind of, flagging a bearish tail here.
Yeah, some great added context there. Now let's take a look at some stocks on our watch list, like Parsons, PSN. It's in the enterprise software group, but it's also sort of an aerospace and defense name as well. It's on the technology side of the defense sector here, and we're seeing a lot of tight action. This week's less than 3% decline coming in mild volume. And it seems like right now this stock that's seen a lot of strong price gains with volume behind it is letting that 10-week line catch up to it.
Yeah, I mean, the three stocks that we're going to look at today are all very similar in that they're under accumulation. I mean, they're showing accumulation, and that can often precede even higher prices. But Enterprise Software Group, really not a lot of good things going on. But I think Parsons is interesting. It's involved in cybersecurity a little bit, but it's also, like you said, involved in intelligence and defense. And the kind of a yellow flag here is this stock has not shown an ability to trend yet. You can see it's been kind of moving sideways ever since it's been a publicly traded company. However, it did move nicely on earnings, and I like the accumulation that you highlighted there on those volume bars at the bottom of the chart. And I think there's a chance this one could come down and test either the 50-day moving average or the 10-week moving average, and we'll see if it can bounce. So at this point, I think we're all just kind of building watch lists of stocks that have potential, and I would put Parsons in this group. I think it has a chance, and you have so many enterprise software stocks that have seen this tremendous multiple contraction where they've fallen 40, 50, 60% off their highs, but Parsons is sort of a rare bright spot in a troubled group. So just it's on my watch list.
Yeah. And let's also take a look at ticker TT. This is Train Technologies. What do you know? An industrial name, working on a handle here, going nice and sideways. Also seeing accumulation. As you said, there's a little bit of a theme here. And this stock consolidating just under that 180 level, finding support at the 21-day.
Yeah, these are the types of stocks that you want on your watch list. And you can't be afraid to look outside of the technology sector with the Nasdaq just looking so vulnerable. But again, similar to Parsons, Train is a stock that is showing signs of accumulation. You can see that in the accumulation distribution rating of A. Nice earnings report and a heavy volume move, and just like the way this one is consolidating here. So it's just below what is that 181. 50, 181.72, or I think, yeah. So it's kind of setting up here, and it's in a good industry. They do commercial heating and cooling systems for commercial and residential customers, and good one to watch here with nice high composite rating and a good technical setup here.
Yeah, and an RS line blue dot on that weekly chart. Gotta love that. And now let's take a look at TEX. This is Terex, also a machinery stock, but this is in the construction and mining group. A successful breakout a couple of weeks ago from a bottoming base right around the earnings report. Lots of strong volume, that accumulation from those big fund managers, big money buying the stock here, and now seeing it maintain those gains. Still has quite a bit of distance between the action and the 10-week line, as well as the 50-day line here, but yet another stock with orderly sideways action in light volume at moving average that's containing the move.
Yeah, and that recent high of 46, 47, I think by not this week, but next week, we could have a flat base, in place here if the stock continues to, trade tightly above this 21-day. I mean, it could actually go below the 21-day and still probably have a flat base intact here in just a little while longer. But kind of a similar setup to Train Technologies that we just looked at. Terex is tracked in the same industry group as Caterpillar, and they provide aerial work platform equipment, and they also do materials processing equipment. So a lot of miners use Terex's equipment. So like the way TEX is setting up here, just in a nice accumulation phase, and now it's just taking a breather and moving sideways in light volume. So at this point, without a lot of actionable stocks out there, I think investors would be well served just to keep building out these watch lists. That's what we've been doing on Leaderboard, so you can be prepared, because at some point new money is going to start to come in from the sidelines. It's very hesitant at this point with all the murkiness about interest rates and the possibility of a recession, but not going to get too bearish, not going to get too bullish here. Going to be open to any scenario, and we still could see a Santa Claus rally between between now and the end of the year. Conditions are tough right now, but we'll see what this inflation data on Friday holds. Maybe it'll be a breath of fresh air for the market.
We'll have to see. Well, thank you so much, Ken, for your analysis and all of that great advice. We will see everyone tomorrow morning on IABD Live. We hope you join us, investors.com/IABD Live for all the details. We'll see you there. We'll also see you right back here tomorrow after the close.